All right, so why don't we get started? I'm going to hit the record button. I haven't gotten the most recent videos uploaded to YouTube yet, but I'll get caught up on that so that you've also got a higher res version and timestamps. So if you want to go back and visit anything there, you'll have that resource as well. I wanted to start off, though, with something that is going to come up very quickly. It's already at a week away now for this first part of the assignment. So the security analysis, really important part of the class. The whole point of the exercise is to help you to integrate everything that you've learned in the class, both from a theoretical and a practical standpoint, and then go out into the real world where the real data is, and they're not simple contained problems where you're given this, you're given that, and you solve for the third thing. These are much more, the real world is much richer and much more complicated. So I see that I think there's only one person who is not signed up for a team, and we didn't have the class enrollment divided by 3 doesn't come out to an even number of teams. So we're going to have 2 teams that have 4 people on them. I've already got one of those teams set up, and I don't recall who it is exactly. You probably know who you are that has not signed up for a team yet. Just get in touch with me and we can figure out which team to add you to. Hopefully the other teammates will view that as a positive. So there'll be 2 teams with 4 people. The rest of the teams will all be 3. So I'm glad to see that everybody's gotten signed up there for the most part. I did want to just revisit what it is precisely that is going to be due this next Monday. So the 29th, we've got data gathering and initial analysis. So the data gathering shouldn't take you terribly long. I would strongly recommend that if you can use the Bloomberg terminal, particularly to gather the electronic pieces of it, financial statements, things of that nature, even the ratios, that you use the Bloomberg terminal, either remotely or in person. In person is probably a little bit easier just in terms of getting connected and so forth. So there are other sources, so don't feel like you're stuck if you can't get onto the terminal or you can't get to the terminal. So there are other sources, but I think Bloomberg is the easiest. And you're going to be gathering data not only for the subject company, for Sprouts Farmers Market, but also for your comparable or your benchmark companies. So the data gathering piece, obtain 5 years of financial data in electronic form. That's, like I said, off of Bloomberg preferred, but many other sources out there. Probably the other easiest one would be Yahoo Finance. Obtain a copy of the annual report and the quarterly report, the 10Q, 10K, from Edgar or from the website or from Bloomberg. Any of those sources are fine. And here again, now, since we're living in this virtual world, I don't expect you to print this all out. In fact, it'd be a horrible waste of paper for everybody to print out the 10K and the 10Q. What I want you to do is to produce for me an electronic document, preferably a Word doc, where you have the links to all of these items to PDF files. So I can see that you've got it all in one spot. It's easily accessible. Now, if you download those PDFs, I'd recommend you do that. Maybe set up either in Dropbox or Google Drive or something of that nature, whatever you're used to using to do file sharing. And use that resource and kind of use that as a repository for all of the things you're gathering. But in terms of what you're delivering to me for this assignment, make it a Word doc with just the links to the PDF files, and those can be out in the web wherever. So links to the 10K, 10Q, industry-related data. So in particular, you want ratios and key statistics. And again, Bloomberg. Now Bloomberg is not only the easiest, but it may be more difficult, much more difficult to find this data elsewhere. So the industry-related data, and especially the industry outlook, you're going to have to go to Bloomberg to get. And I believe, I'll have to go back, I don't want to jump out of here, but I think I've posted some of that on the resources for the for the security analysis under the module section of Canvas. I don't recall how much of that I actually posted. Same thing with the economic data and the outlook. Now, if you're working for a firm, for an investment bank or a brokerage house producing an analyst report, you would have an in-house macroeconomist, and you would more than likely rely upon their forecast. Since we don't have that, we're going to rely upon Bloomberg's economic outlook for both the medium term, the 6 month to a year, and then out beyond that. We'll rely totally upon Bloomberg. And that's also why, you did those first 3 modules. You did the terminal basics, you did the economic indicators, and you've got the equity pieces out of the terminal. All right, so, and then obtain any other current data. So here I'm talking about going out to, you can just do Google searches, or you can use EBSCO out of the library, whatever you're comfortable with. But what we're looking for is current articles about the grocery market and retail in general, and Sprouts in particular, and maybe the competitors to Sprouts, all of those sorts of things in the popular press. So the business press, the popular press, Wall Street Journal, Forbes, any of those, all the way out to, any sort of popular press that you might want to choose, magazines, newspapers, maybe even Bloomberg TV or CNBC, things of that nature. And again, just provide me with the links. And I would say, the more the merrier on that score. Remember, at some point, you're going to have to read through all of this stuff and try to integrate it. Right now, all I want you to do is just go forth and gather it all together so it's in one spot. And then as you start entering into the next part of the project, you'll actually have to go through and read this. And here again, while this is a team project, some of these things are something that each individual teammate must do. So each individual teammate must read the 10K, must look at the 10Q and see what the updates are, must read all of these current articles, must look at the economic forecast, the industry forecast, and understand it, so that when you're discussing it with each other, you all have kind of the same background. Now, you can break up some of the tasks, and that would be, for instance, some of the next items here on the list, working on the spreadsheet, developing the graphs, even picking which firms are the comparables, which are the firms that we're going to use as our benchmarks. But some of the tasks everybody has to do, and when it comes to the reading, if you don't read it, you're really going to be in the dark, and you're not going to be a lot of help to your teammates. By the way, let me know if there are any issues in terms of teammates not performing up to the level that anyone thinks might be acceptable. If people are not making meetings, if they're not contributing the part that they said they were going to contribute, and so forth. I need to know that, and I need to know that well before the end of the semester. Don't come to me after the report has been turned in and say, oh, by the way, so-and-so didn't contribute at all. I need to know that as soon as possible so that we can try to remedy that. Hopefully we can work through most of that. Hopefully that won't be an issue. If I do see that there is a potential for that, I also reserve the right to implement kind of a peer review feedback loop that I would have all of you do. And so you would be evaluating not only your peers, but also yourself as you contribute to the project. But just know that that's out there. I hope we don't have to use it. I don't like to use that sort of thing because that seems more punitive. But let me know if there are any potential issues. I'll keep it confidential and so forth. But anyway, okay, the next, so you've got these first items, the obtain items, these first 6 checks on the list, pretty easy, right? The next items, okay, so now you're going to use the information you've gathered to create a spreadsheet of the financial statements and financial ratios. And here again, you can pull the financial ratios from Bloomberg already computed. So I would say, to save time, that's the route I would go. Now, again, if we're doing this for real and with real dollars and your job's on the line, I would want to make sure that I computed my own ratios just to double check them. I may pull Bloomberg's, but I'm gonna double check how did they compute this so I know what's going on. You go through some of this when you're in AC 310 about how exactly to compute these ratios. There are different ways, and one might tell you something different than the other. So in this example, if you're pulling them off of Bloomberg, as long as you're pulling the same ratios for the same set of companies from the same source, you should be all right. We're not going to get down to that level of detail. So you've got the ratios, the 5 categories that I'm referencing here. The additional notes handout is in the resources section for the security analysis under modules in Canvas. So go to that if you're unsure of what ratios are typically used. I've broken it up into the 5 primary categories, and then there are a variety of ratios within each category. You won't necessarily use or need to use each and every one of those ratios. It depends upon the company, right? I mean, we don't have a dividend yield, so we don't need to look at dividend yields, but we may need to look at some of the other metrics that reference kind of profitability. And in some cases, we're always going to look at a ratio. We're always going to look at operating profit. We're always going to look at net income as a relative to equity, relative to assets, that sort of thing. So now you've got all of those put together into a spreadsheet. You'll also want to do the DuPont analysis. And again, that's in that additional notes handout as to the breakdown. But essentially what we're doing there is we're taking the ROE and we are breaking it up into 3 component ratios. If you want to go further than that, there are various versions of the DuPont analysis where it breaks it up into 4 or 5 ratios. But again, for these purposes, the 3 should be sufficient. And the 3 are efficiency, profitability, and leverage. All right. Those don't tell you anything necessarily in and of themselves. But what we're going to do is we're going to take those 3 ratios and we're going to look at those relative to the comparative firms, the competitors that you've developed, the group of firms that you're going to compare Sprouts markets to. And that will help us to uncover what Sprouts does well and what they don't do so well. And then we're also going to go back to the 10K or any other management discussion that we can find and find out whether management is cognizant of these sort of weaknesses or strengths and what they're doing to remedy them if they're a weakness, what they're doing to take advantage and leverage them if they're a strength. So that's what that DuPont analysis, or AKA ROE decomposition, is all about. Then you're going to plot some ratios over time, and it's going to be the firm, so Sprouts Farmers Market, and relative to the comparator firms, relative to the competitors. And you want to, I think you'll want to do this in 2 ways. One, you would take an average of the comparator firms, and the other, you could actually plot them all individually. And you want to look at each piece of data that comes out of that, because some of the ratios may be just completely out of line, and they could drive an average, particularly since we're talking about 3 or 4 comparator firms. And as a result, it matters what those values are. If there's a ratio that looks out of whack, you might even just throw it away because it may unduly influence your average. But you're going to have these plots. And then finally, you're going to compute the coefficient of variation for both sales and operating profits for Sprouts Farmers Market. And that also is detailed. The process and how you get a COV is detailed in the additional notes handout. And then do a brief description of what you think that is. So what we're really looking for there is how much the the cash flows, the variability in the cash flows of SFM is influenced by the fixed cost component of their cost structure. So remember, we've got financial leverage, which is how much debt do we have on the balance sheet, how much of our asset base is supported by debt. That creates risk. The greater the financial leverage, the more that our assets are funded by debt, the greater the risk of our equity piece. Operating leverage is this idea that is captured in the coefficient of variation on sales and operating profit, and that is, if we have a very large fixed cost component, then a small dip in revenues is going to cause a very big dip in operating profits. If we have a very small fixed cost component to our cost structure, then a dip in revenues is going to be pretty much mirrored by the same dip or rise in operating profits. So that's pretty much it. But this first bit, the gathering can be done in a matter of a few hours, right? These last 4 items are actually going to require a fair amount of work on your part. So don't wait till Sunday to do this. It will not work well, and you won't get what you need to out of this either. So the one thing that I've been referencing here, and I haven't actually gone into a lot of detail about, is the firms that you're going to compare SFM to. 4. So pick 4 competitive firms that you think best mirror SFM. All right. Now, it'd be nice to be able to pick something like Whole Foods, but we know that Whole Foods has been acquired by Amazon, so we don't have any detail on Whole Foods anymore. But so you're going to have to go out there and you're going to have to find something else that matches up. And remember, it doesn't absolutely have to be just a single line business like SFM is. I mean, SFM is just groceries, right? You may not find that. And so you may have to find companies that are in a slightly different marketplace. Obviously, some of the mainline grocery stores could be likely comparables, but they're not all perfect matches to SFM and their market, the market niche that they hold. So you're going to have to dig around a little bit. This is probably going to be one of the more debatable topics, is picking who the competitors are. Who are they actually competing against? And what is a relevant benchmark to use? So I'm going to leave that up to you. What I'm looking for is that you justify those choices that you make. So if you choose Kroger's as a comparable, I want you to talk about, why did you choose Kroger's? It's a lot bigger market cap firm. Is that reasonable? They don't necessarily focus on that organic segment of the grocery market. Is that reasonable? Or maybe you're left with no better choices. But again, pick 4 that you're going to use as comparables. And there, you're also going to be pulling those ratios for those companies, because you're going to need them to do these plots, and you're going to need them to do the ROE decomposition. So it's important that you pick publicly traded firms. You can't pick a private firm because we don't have the data to deal with that. So we are very limited in terms of our choices here. But again, it's up to you to walk through that exercise. This is part of the real world. It's part of what makes it difficult. If you're just given, hey, use these 4 firms, yeah, where's the value? What value are you bringing to the table? The better the comparables, the better the analysis, though. So keep that in mind. I'd spend a fair amount of time on thinking through that. Bloomberg is going to give you a list of firms that Bloomberg thinks are in that industry. But that doesn't mean that just because they're in some not arbitrarily constructed industry, but a construction that is not made with the purpose that you have in mind, doesn't mean that all of those firms are reasonable comparables or competitors to SFM. All right, so this is where you're going to bring some real serious value added to the project. So think about that. Get all of this stuff gathered and turn it in as a Word doc with links and a spreadsheet. as well. Obviously, you're going to have a spreadsheet for the DuPont analysis and the graphs and the financial statements, but the rest of it can be in a separate Word doc. So let me open it up before we get into lecture today for any questions that you all have.
For the submission of this, is it just going to be something on Canvas?
Yeah, what I'll do is I'll open up an assignment and allow you to upload both Word doc and Excel and PDFs.
Okay, thank you.
Mm-hmm.
Do you think you'll be like you respond really fast usually? Do you think you'll be on your phone or email like easily accessible during this time in case like once we get with our groups and we start like getting to work, you'll okay.
Yeah, absolutely.
I didn't ask that question the way I wanted to, but
no, I understand exactly what you and in fact, I'd be willing to, if you want to have a brief Zoom meeting, if it's something a little more complex that you want to hash out with me, I'm absolutely available for that. I can't promise, immediate turnaround, but many times, hey, email me and I'll say, yeah, let's do the Zoom room and jump in 15, 20 minutes, or it still might, sometimes it might take a day, but I hope to keep it less than 24 hours. And if it's shorter questions, just an email. We can do a phone call too. I'm open to all of that.
Okay.
Yeah. Anything else? I'm guessing that folks haven't really gotten started, so I think Brett's question is going to be more important. So feel free to reach out. But here again, timing. If it's Monday afternoon and I'm getting hit with 3 or 4 or 5 teams asking those last minute questions, I may or may not be able to spend as much time with everybody. So get started on this right now. Get started on it today. Get to the Bloomberg terminal, start pulling some data today so that you've got a little bit of time on your side. Have somebody go out, if one person goes to Bloomberg, get another person going out to the web and doing a search for the current information that you're going to find in Wall Street Journal or Forbes or so on. Kind of split some of those tasks up. But like I say, the reading part of it is something that everybody has to do. All right? All right, good. Yeah, sorry, Zach, go ahead.
Do you mind just kind of giving a little more detail on what you're looking for the industry outlook and the industry-related data, ratios and statistic-wise? What do you want to see there?
What I want to see is essentially what Bloomberg will give you. And they have a fairly... usually it's fairly up to date. I know I've looked at the. Hang on a second. Since we're pretty much done with this, let me go back to the modules. I did. I thought I had uploaded this. So you see this third link under resources, the Outlook North American Retail Staples. So this is, I believe this is what I pulled off of Bloomberg. Yeah. So you're going to go into Bloomberg under BI is going to be your code up in the little blue bar, and that's going to give you get you to the right spot for this sort of thing. And so here's the general outlook on retail staples. And so it could simply be this. Now I'd recommend that you go out and let's see, what's the date on this? I pulled this a few weeks ago. 2021. Anybody see the date offhand? Am I missing it? It looks like March 9th. So I'd recommend going into Bloomberg, just seeing if there are any updates. If you can find anything that is just specifically groceries, that would be even better yet. Does that help, Zach?
Yeah, it does. Thank you.
Okay. All right. Very good.
I have another question about the industry outlook part. So, you were kind of saying earlier you couldn't find where you put the information on the competitors. So do you kind of want the competitors' information in like the industry outlook part as well? Or is there like another spot on competitors that I missed?
Yeah, there should be, and I rewrote this assignment this semester, and I think I have to go back through it. I may have somehow wiped that away. Generally, what I want out of that at the end of the day, and this, you don't necessarily have to do that for this 29th due date, but what I want is a brief discussion about why you picked each of the four. So talk about their market cap, talk about their primary product delivery, what, if there is a direct comparable in organics that isn't Whole Foods, yeah, you definitely want to pick that up. Are they a lot smaller? Are they a lot bigger than Sprouts? If you're picking one of these major national grocery stores, then you're going to want to talk about, I'm a little less keen on this one because it's 10 times the market cap, but we still think it's a reasonable competitor for or comparable for these reasons, whatever reasons you want to choose. Maybe they carry a fairly substantial portion of organic produce and organic products, and you think that that might actually be a direct competition to Sprouts. So yeah, just a brief few lines on each firm as to why you chose that particular firm as the comparable. Okay, you're welcome. Other questions or comments? By the way, here's the additional notes. And make sure you read through that. That'll help you out a fair amount. And what else did I've also got some, let's see, two-stage residual income model. That'll be for later. Some information about Chipotle here. This was back last semester we did Chipotle as the firm that we analyzed. So you could look at that and kind of possibly use that as a framework and say, well, I want to look for similar information related to SFM. This was the Chipotle PDFs were provided to us by Nancy Bonacci, who is she's now the vice chair of the board and is a retired analyst from KeyBank, director of research at KeyBank. So she was very helpful in providing that information. So look at that, because that will kind of give you an idea of what an actual analyst is going to be having at their hands. Now, can we replicate that for SFM? No, not without Nancy's help. And but you can get some idea of what the analysts were looking at in that particular case. The other thing that I would recommend, where did I put that? Oh yes, I think it's up here. Yes, right here. So under week 3, where we're doing common stock valuation, is where I've got all the information that Aswath Damodaran has made available. And again, this is not necessary for this due date, this 29th due date. You're just gathering it. You're putting together some spreadsheets. You're putting together some plots. But if you go to the valuation videos, those are that's the link. And then I've given you the some of the detailed videos that will be helpful. And then also all things valuation, going to Aswath Damodaran's website. He's just got a wealth of information there. So I would do that as we're going along this process. This is not, there's no quote unquote assignment or things of that nature, but it's something that at least one teammate ought to avail themselves of, and ideally all of you do, because to really understand this stuff is going to take quite a bit of legwork on each teammate's part. All right. If there isn't anything else, why don't we turn to Chapter 10? So, Chapter 10 gets us into bonds. And bonds are something that a lot of people kind of overlook. Bonds are a little trickier than equities, or at least seemingly less intuitive, I guess I would say. They're not. They don't quite have the sizzle that you might find in the equity market. But the fact of the matter is that going back, think back to the behavioral stuff that we were looking at. Remember the example of the Mary, I believe was the name of the fictitious character that was studying library science and was a member of the Sierra Club and so forth. And what did Mary do when she got done with school? Well, most likely she was in the banking industry because there are a lot of jobs in banking. Well, bonds are a lot like that. There are a lot more jobs in bonds than there are in equity markets. Right? So more than likely, this is going to be a very important set of information out of this chapter. Now, we only spend this chapter on it. Now, you get a little bit on bonds and yields and fixed income, that sort of thing in your markets and institutions, maybe a little bit out of money and banking, that sort of thing. But this is a pretty big part of the field. Why are there so many jobs in bonds or related to bond markets and things of that nature? Well, just think about it for a second. If I'm a portfolio manager and I'm managing an equity portfolio, I can pick a bunch of stocks, put them into a portfolio. Stocks have theoretically an unlimited life. They're pretty much going to be there. I might do a little bit of rebalancing at the margin, but I don't have to worry about too many of those stocks disappearing, especially if I'm talking about mid-cap and large-cap stocks. Some of them are going to go bankrupt, but that's a relatively small percentage that are going to go bankrupt, and then I have to do something about it. Bonds, on the other hand, they have an expiration date. They have a maturity date. They always disappear. And by the way, the duration of a bond is always changing as yields change, as we move closer to maturity. So if I'm trying to do any sort of duration matching, and by the way, I don't expect you to know what that is yet. I mean, you have read it, but we'll talk about duration and duration matching and immunization at the end of this chapter. Won't get to till Thursday. But that sort of thing is a very dynamic process. On a weekly or monthly or quarterly basis, you're doing rebalancing all the time. So you're buying and selling bonds all the time. And in order to hit a particular target duration. So unlike equities, there's a whole lot more work involved in this, and not all of that work can be done by computers. So there are just a heck of a lot more jobs out there that relate to bonds than do relate to equity. And actually, I mean, there's still an equal amount of money to be made. So these are important topics here. So we're going to talk about bond prices, yields, the importance of yield to maturity, some of Melchiel's theorems, and then we're going to talk about things. This fourth one is actually related to what the topic called duration and duration matching and immunization. Okay, so some of the basics. I mean, everybody knows what a straight bond is. It's an IOU. It obligates the issuer of the bond to pay the holder of the bond some fixed sum of money at the bond's maturity, and then prior to that time, they're paying some sort of periodic interest payment called coupons. U.S. Treasury bonds are straight bonds. Many corporate bonds are straight bonds. Bonds also can have these add-on features. And when we try to value these add-ons, we actually use something very much like the option valuation techniques that we're going to learn about at the end of the semester in I believe it's chapter 15, when we talk about option valuation. So convertible bonds give the buyer of the bond, the holder of the bond, an option to convert their bond into a fixed number of shares of equity. So as the value of the equity goes up, the value of that option goes up. This is a fairly common feature that's added to a bond. So in other words, what it gives the bond holder is the opportunity to get in on some of the equity gains. So if the firm's doing really well and you hold a convertible bond, then at some point you might want to convert that bond into equity. And you make quite a bit of money. Now, what's in it for the issuer? Well, the issuer can issue that bond with a lower coupon rate than a bond without a convertible feature. So effectively, the holder is paying a premium to the firm in the form of a discounted coupon rate. Callable bonds are actually an option from the issuer's side, And that gives the issuer the right to call that bond back in. And the only time they're going to do that is if interest rates are declining relative to the coupon rate on the bond. So it's sort of like refining on a home mortgage. Mortgage rates are at a fairly historic low right now. So even if you bought a house 7 years ago, you're going to be able to knock 1% or more off of your mortgage rate by refinancing. And that's the same sort of thing that a corporation might want to do, but they have to have the right to call that bond in. With a mortgage, that's embedded in the contract. Every mortgage, or any mortgage, let me put it this way, any mortgage that you should take out has a feature that's effectively a call feature. And it gives you the right to repay the entire principal at any point in time prior to maturity without penalty. So that gives you a callability feature. Not all corporate bonds are like that, though. They have to have that built into them. Putable bonds give again, this is an option that the holder of the bond has, and they can put the bond back to the issuer earlier than maturity. When might you want to exercise an option like that? When might you want to put a bond back to the issuer and get back the face value prior to maturity? Well, let's think about what's the relation between yields or market rates and price of a bond.
Is it an inverse relationship?
Yeah, it is. Thanks, Brett. So as yields go up or market rates go up, the price of the bond goes down and vice versa. So when we put a bond back to the corporation, we put it to the corporation at face value. And typical corporate bonds have a face value or a par value of $1,000. That's just, it's sort of like, you go to the grocery store and you see that beer is sold in 6-packs, right? Could it have been 4-packs? Yeah. Some beers 4-packs? Yeah. But most of them are 6-packs. Most corporate bonds are $1,000 face. So you're putting this bond back to the corporation for the face value. So when might you want to do that? Well, you might want to do that if the market price of the bond is very low, meaning that the yield has gone up. So if you have the right to put it to the corporation for face value, that's valuable to you. So there aren't that many bonds that are puttable these days, but what it does do for the corporation is, again, they get to issue, when they issue that bond, they can issue it at a slightly lower coupon rate than the going market rate for an otherwise similar risk because they've added this put feature. It gives the issuer an option to get more money back out of the bond later on if rates go up. A couple of very basic things here, coupon rate and current yield. Note that the key difference is in the denominator here. It's not, the numerator is the same in both cases, annual coupon. The only difference is that in the case of a coupon rate, we're dividing it by the par value or face value of the bond. And in current yield, we're dividing by the current bond price. Now, to the extent that, again, back to the inverse relation between yields and price, if the price of the bond is down, then the current yield is going to be higher than the coupon rate. If the current price of the bond is above par value, then it's going to be lower than the coupon rate. Price of a bond is found by adding together the present value of a bond's coupon payments and the present value of a bond's face value. And the rate at which this exercise yields the current market price of the bond is called the yield to maturity. Now, I want to jump over here, time-wise, okay, we're good. We got about half an hour. I want to jump over here to a spreadsheet that hopefully will help you to think about this in a little different way than we typically do. So when you were in 312, and you probably had some exercises like this in 316, of valuing some cash flows. Pretty easy stuff. And so let's start off over here. We've got the face value of our bond or our par value at 1,000.
I've got a market rate over here of 5%. I've got a coupon rate of 5%. And here I have two different bonds. One of them is a 0, and we'll look at that later on. That's going to actually help you to hopefully understand duration at a much deeper level. But the one that I want you to pay attention to here is this coupon bond. So here we have a coupon bond with a 10-year maturity, and we're going to assume that this is an annual coupon just to keep things simple. So we get 10 coupon payments of $50 every year for the next 10 years, and then on that final year, we get the face value back plus that last coupon payment, and we're done. Now, the typical discounting that you do in 312 or 316 is you discount each coupon payment. So notice here what I've done. I've taken that $50 that I receive 1 year from now, and I've discounted it at the market rate, 5% in this case. And so basically I have $50 divided by 1 plus 0.05 raised to the first power. And that gives me $47.62. The next coupon payment 2 years out, same coupon payment, but I'm discounting it now not for 1 year, but for 2 years, and I get $45.35. So on down the line till I get to the last payment in the last year, and that includes the face value or the par value of the bond, that extra $1,000. So the present value of the coupon payment is a combination of those two. So the present value of $1,050 10 years from now at 5% is $644.61. Then I go up here and I add that whole mess up, and that gives me the market price of the bond. That's what you're accustomed to doing all the time, right? Okay, so let me pose to you something like this. Look at it in a slightly different framework. Let's look at it, instead of discounting these cash flows over here in column C, let's look at moving all of the, so let me back up a second. What we've done here in column D is we have moved all of the cash flows back to time 0. And we do that through this discounting process. Let me suggest an alternative, but a method that comes up with exactly the same answer at the end of the day. And that is, I'm going to move all of the cash flows out to time 10, at the end of year 10, the maturity date. Then I'm going to take that lump sum, and I'm going to move it back to time 0. It'll make sense as to why I'm doing that extra step in just a second. So here in column E, what I've done is I've taken that $50 that I receive 1 year from now, and if I don't know if you can see, I don't think I can enlarge this too much. There, let's at least get, at least highlight the cells that I'm referencing in this formula up here at the upper left. So what I've done is I've taken that coupon payment of $50 in C8, and I'm multiplying it by 1 plus the market rate, that 5%, and then I'm raising it to the 9th power. So I'm grossing it up. So in other words, when I receive that coupon payment 1 year from now, I'm going to reinvest it in a similarly risked fixed income instrument. And I'm going to reinvest that for 9 years until maturity date. So that's what I'm effectively doing with this formula. And I've done that with all of these. Oops, what happened here? Oops. No, I messed up. Sorry. And okay, let's go back to here. All right, so oh, darn it. Now I don't have the backup option here. That should have been $77 there. I followed up my equation. Let's see if I can fix that. Yeah. I need that to be that. And then enter. Okay, there we go. All right, sorry about that. So that $50 becomes $77.57 at the end of year 10. So I've grossed this up. I've done that to all of these coupon payments, and notice the further out they are, the less time I have to earn interest on the coupon payment itself. So this last coupon payment, I only earn an extra $2.50 by investing it at 5% for 1 year. And then this final one is at time of maturity, so it doesn't get any interest. When I add these guys up right here, I'm adding them up, I get $1,628.89. That's the value that I get out of this thing. Now, one last step. I'm going to take that lump sum of $1,628.89 and I'm going to move it back 10 years to time 0. And I'm going to use that same market rate. I'm going to use the 5%, and that's exactly what I've done here. Notice that I get exactly the same price for this bond. Why is that important? Well, part of it is just being able to think both directions about calculating a bond value and what's implied in that formula. But you're going to really see the value to this when we start talking about duration. Let me just give you a brief preview so that maybe this will help lock it into your minds. But notice, let me change this rate up here. Let me change it from 5% and let me change it to 4%. Now watch what's going to happen to the numbers in column E. If I decrease my compounding rate, what's going to happen? Those numbers are going to drop, right? So here, let me change it to 4. Aha! That 77 dropped down to $71. So I'm $6 worth off with that coupon payment. Notice too that overall the value of the bond, because the market rate went down, the value of the bond actually went up. But notice that the reinvested coupons values went down. This one goes up, one goes down, or vice versa is what we're seeing here. Okay, so when rates go down, the value of my bond goes up. All right, everybody sees that, right? So we've got that 1,600, but because it's less than what we had before, but we're discounting it at a lower rate to bring it back to time 0, so that 1,600 ends up being worth more than $1,000. It ends up being $81.11 more valuable. But our reinvested coupons earn less, because we're reinvesting them at a lower rate into the future. And vice versa, if we change that from 4% and made it 6% instead, notice that here again, our value drops because we're discounting this value that we have grossed up at the end by a much bigger number. So the value of our bond drops down to $926.40, but the reinvested coupons get reinvested at this higher rate. So we actually get more out of those things. So we've got this, price drops, but the value of our reinvested coupons goes up. Duration, which is one of the most important fundamental theories out there about bonds. What duration does is it says, you know what? If we lose $100 on the value of the bond itself, but we gain back $100 by earning extra interest on the reinvested coupons, gaining 100, losing 100, we have a net zero. We can immunize ourselves using that concept. So duration is a number, and actually that number is stated in terms of years. It's stated in terms of time. It's that number where if we hold the bond to that period of time, that the gains that we make on the interest payments will exactly offset the losses that we suffer in the value of the bond, and we'll be able to fix the amount of money that we end up with at that point in time. It'll be a time prior to maturity of the bond, and it'll vary depending upon a number of characteristics of the bond and the market rate of interest and so forth. But there is a period of time that we can pick for a coupon-paying bond that is prior to maturity that will exactly have those two things, those countervailing forces, offset each other. It's a really important concept. We'll dig in deeper to it, but I wanted to present you this at this point in time because really, effectively, this 6%, this market rate, or 5% or 4%, that's our yield. So if a bond that we're looking at is priced at 926.40, it's yielding a yield to maturity of 6%. If it's priced at 1,000, it has a yield to maturity of 5%. In this case, that's exactly equal to the coupon rate, and so forth. But that's the idea behind this yield to maturity. It's whatever the market rate is, that's what we use to discount our cash flows to come up with the price of the bond. Or if we know the price of the bond, then we can back into what the yield is, the imputed yield from this. But I wanted to also present you the concept that I'm showing you here in column E, so that duration is one of those things that you have to kind of, it has to kind of sit in your head and you know, ferment, I guess is the best word for it. It's not unlike options. Options are just foreign concepts to most of us when we first see it. It's not something we experience in the regular world. And so it takes a little bit of fermentation in the head, cogitation, if you will, for us to understand it. So start thinking about it. That the overall idea behind duration, though, is to have those two amounts offset each other. And as a result, then I'm able to determine an exact value of my bond investment at some point in the future. And that's a valuable thing. If I'm a portfolio manager on a pension fund, I know that I'm going to owe my pensioners some amount of money at some date in the future. And if I can create an investment using bonds that will guarantee I have that amount of money available to me, that makes my job a whole lot easier. All right, so that's the sort of thing that we're going to get to at the end of the chapter. Questions about that? Because it's a weird, again, it's a weird topic or a weird theory to really grasp. All right, so let's keep going here. So we've got yield to maturity. That's our discount rate. We can use these closed form equations here. I like to break the equations up into at least intuitive chunks that are a little more digestible. So under the equation above the green line here is are the annual coupon payments. That's the value of those annual coupon payments. And this is a closed form solution, so we don't have to do any sort of summing. We don't have a summation in there. All we have to do is type in the coupon payment. And this particular formula actually is designed specifically for a bond that has semi-annual coupon payments. That's why we're dividing the coupon by 2. That's why we're also dividing the yield to maturity by 2. And we're multiplying the M, the number of years to maturity, by 2. So don't try to use this formula on anything other than a semi-annual coupon payment for a bond. But most bonds are semi-annual. Sometimes you'll see exercises where we use annual just to keep the computation simpler. But so the equation, or the portion of the equation above the green bar here, relates to the coupon payment itself. And then this portion over here is simply that final lump sum that we get on the day the day of the maturity on the bond. So that's the face value that we're getting back. And again, we're discounting it back, M times 2 periods. So if in the example that we're looking at in the spreadsheet, if that had been a semi-annual bond with a maturity date of 10 years, we would discount that back 20 periods, 26-month periods. Otherwise, it's pretty much a plug and chug. So here I found an image of a old bearer bond, what's known as a bearer bond, B-E-A-R-E-R. And bearer bonds were very common 100 years ago, not so common today. most bonds don't have coupons attached to them. And notice that down at the bottom here, we have a bunch of what look like coupons, which they actually are coupons. So what you would do is you would actually clip off the one that was currently due. So for February 15th, 1987, we would clip that off. We would send it into the company. They would send us back a check for $45. This is a semi-annual bond. Notice that the annual rate here of 9%. So we simply divide that by 2. It has a face value of $1,000. So that's the semi-annual payment is $45 every 6 months. And literally, we would clip those coupons. It's called a bearer bond because whoever holds the bond, the bearer of the bond, actually gets the coupon. Now, bonds today, you're on file with your address, you own this bond, and the company automatically sends you a check for $45 for each bond that you own. Now, there are advantages to that in the sense that you don't have to hassle with sending in a coupon. And the other advantage, and probably the primary reason that we have done away with bearer bonds, is that the IRS happens to also know exactly what kind of money you're getting. So they can send you or rather you'll get a 1099 on that, and you'll have to pay tax on the earnings. The other problem, though, with these bearer bonds is just the fact that whoever held the physical bond, they would get the coupon. So these things were very, you could steal one and clip it off, send it in, and you got the coupon. So there was a fair amount of risk embedded there too. Now, we don't have to worry about it. It's all done electronically. All of our information is with the issuer, and they automatically send it out. But these bearer bonds had a place, and you'll notice that this one actually, looks like 1987, 1988. So there's still a few of them around. What else about these things? Well, here's our face value. Here's our coupon rate. Here is our coupon. Now, when the price is greater than the face value, so that's up here, that means that the market rate is less than the coupon rate, or vice versa, whichever way you want to go. When the market rate is greater than the coupon rate, then the price falls below the face value, and that's called a discount bond. By the way, I didn't mention this, but it's over here. When the market rate is less than the coupon rate, the price is greater than the face value, and that's called a premium bond, the discount bond. And then finally, the par value bond is when the market rate is exactly equal to the coupon rate, then the price of that bond is also equal to the face value or the par value of the bond. So we've got 3 different names here. Par value, which very infrequently is the case, but typically a bond is either selling at a premium or at a discount. The par value piece of it only comes usually on the day of issue. Then the bond is, they attempt to price it very close to par value. It doesn't even always work there too, because interest rates are constantly changing over time. They've set it up as, okay, we're locking in this rate. By the time it actually goes public, the rates have changed. So it's going to be slightly under or over the face value that it sells for, but it's usually priced very close to that. We pick a coupon rate that's very close to the market rate when we first issue a bond. Here's what happens to the price, and you'll see that very shortly we're going to be talking about Melchiel's theorems as it relates to price and yield of a bond and time to maturity, things of that nature. And he's going to describe in words what this graph shows us in a picture. And you'll notice here, note that we're looking at time to maturity on the x-axis, and it's 0 on the right. Over here, so maybe it's flipped from what you might be thinking. So this point in time is a 30 years to maturity. Here we have 20 years to maturity, 10 years to maturity, and we're right here, we're at maturity itself. Whoops, I'm in the way. Right here, we're at maturity. All right, so now we're looking at the amount of premium or discount for a particular difference between the market rate and the coupon rate. So we're going to keep that difference the same. We're just going to look at different times to maturity. So you notice that if we have a particular difference, if we have a yield that is above the coupon rate, and we have 5 years to maturity, the price is at 90% of par, approximately. But if we have that same difference between market rate or yield and the coupon rate of the bond, and it's 25 years to maturity, notice that that puts us closer to 82.5% of par. And it's also important to note that this curve, notice how the slope is like that, but then it starts to flatten out, and then it gets even flatter here. So the rate of change in the price of the bond differs depending upon the time to maturity for a similar change in yield relative to the coupon rate. And you'll see the same effect here on the premium side of it. It's a non-linear relation. The slope is much greater here, so the price hit, if you will, for an equal difference between market yield and coupon rate has a much greater impact on the pricing of the bond than when we have a very long maturity bond. That's what that graph is hopefully relating to you all. When we start thinking about these three measures that we commonly look at with a bond, coupon rate, current yield, and remember, coupon rate is simply annual coupons over par value or face value. Current yield changes that par value to current price. Both of those items ignore the repayment of the face value at the time of maturity, whereas yield to maturity takes that into account. So for a premium bond, the coupon rate will be greater than the current yield, will be greater than the yield to maturity. That relation is fairly important to commit to memory if you can't think it through theoretically. It's eventually you won't even have to commit it to memory. You will be able to think about this. But think about the idea that here, when we have a bond that's selling at a premium, the price is greater than the face value. Clearly, the annual coupon is constant, so the only difference between coupon rate and current yield is the denominator here. And if it's a premium bond, that current price is a bigger number, so that's going to make current yield smaller. That's how I think of it. The reverse is true for the discounted bond. Notice that current coupon rate is less than current yield, and for the exact opposite reasons. Yield to maturity gets a little more complicated, but note that we're bringing in that additional cash flow that we're not considering in either of these two cases. We're bringing in that final repayment of the original principal of the bond. And for a premium bond, remember, when we buy a premium bond, let's see, let me just do this on a timeline, I think. So at the end of the period, we're going to get $1,000 back, right? This is maturity date. However, out here, when we buy it, we're going to pay $1,200 for that because it's selling at a premium. The yield is below the coupon rate, so whoever sells it to us can demand that premium. So it's this $200 differential relative to what we get back that's driving this relation, that's making YTM less than both current yield and coupon rate. Because we don't get that 200 back, we get 1,000 back. And the reverse intuition holds when we're talking about a discount bond. So in other words, with the discount bond, we might only pay $800 when we buy it, but again, we still get 1,000 or face value back. So we're picking up, whereas here it was a negative 200, here it's 200 to the good. So again, that's what drives the fact that YTM is greater than current yield is greater than the coupon rate for a discount bond. And in the case of a par bond, they're all equal to one another. Again, this is just more of a definitional thing. Bond quotations. The bond quotations do not account for the fact that we're getting these prices in between interest payments. So when one party sells their bond, if they didn't sell it on the day they received the interest payment for the prior period, then they're actually due some interest. Now, the interest payment doesn't come for another 5 months and 15 days or something like that. But they're still due that first 15 days of interest. And how do we account for that? Well, what we do is we take the actual price that we have calculated and we add on that extra interest. So we take what's known as the dirty price, or excuse me, we take what actually it's the reverse. The clean price is what we would actually calculate. Then we add to it the interest that is owed to the seller, and that is the dirty price. And that differs from each time that the bond is sold. So if we sell a bond today, the dirty price is different than if we sell the bond tomorrow. Even though the clean price has only changed one tiny bit, the dirty price will change by more. Callable bonds, I already talked about that. And yield to call. Let's just briefly discuss that, and then we'll call it a day. It looks like it's about 1:42. The only difference between call to maturity and yield to maturity and yield to call is the timing. So usually a callable bond has a period of time immediately after the issuance of the bond during which that bond is not callable. Typically on a 10, 20, 30-year bond, that'll be a period of 5 years. Might only be on a shorter-term bond. They might shorten up the no-call period as well to maybe 1 or 2 years. But typically, it's a 5-year period where the company itself is unable to call the bond. No matter what happens to interest rates, they have guaranteed we will not call the bond before year 5 after issuance, even though they might want to. So for the bond holder, for the person buying the bond, the question becomes, which is more relevant, yield to call or yield to maturity? And if we're in a fairly volatile interest rate market, then I would argue that yield to call, that's the earliest time you would get your principal back. That is the more important figure. Why is it more important? It's more important in part because, look, when are they going to call the bond? When interest rates have fallen. That means that they're going to give me back my $1,000 of principal, and I'm going to have to reinvest that at a much lower rate. So that's of a concern to me. And so whenever we have a callable bond, the relevant measure is no longer YTM, but YTC. And I think that's a good spot to stop. Yeah, in fact, getting into interest rate risk and realized yields and so forth. We'll pick that up on Thursday. Got about 1 more minute. Anybody have any questions so far about this or anything that's come up in terms of the security analysis and the project and what's due this coming Monday? All right. Then I will see you all on Thursday. Otherwise, have a good couple of days. See you then.